After a big drop in the stock market, is the tech bubble about to burst? U.S. stocks just posted their worst day in a month, with the S&P 500 and Dow down about 1.7% and the tech-heavy Nasdaq sinking 2.3%, the biggest decline since October 10th. Investors are suddenly nervous that incoming data could upend bets on a December rate cut that many had taken for granted. Odds are roughly 50-50, and skepticism is rising that the Fed will cut soon, given stubborn inflation and still easy liquidity. If the market is this sensitive to tiny rate moves, that's not a sign of strength. And at the center of this turbulence sits a massive, messy question. Will the promised AI payoff actually accrue to the companies everyone is betting on? Here's the reality driving the fear. At the top of the market, a small group of giants has carried most of the gains, while much of the rest of the market has been flat. Meanwhile, a strange circular flow of cash is surging between the biggest AI players. According to reporting cited in the transcript, OpenAI has taken in billions from tech companies and then sent those billions right back to buy cloud and compute from those same companies. Microsoft put more than $13 billion into OpenAI, and OpenAI in turn bought cloud computing from Microsoft. When that wasn't enough, OpenAI signed big cloud contracts elsewhere, including Oracle and a lesser-known data center builder called CoreWeave, agreeing across deals to pay CoreWeave more than $22 billion for compute, while receiving hundreds of millions in CoreWeave stock. SoftBank reportedly lent OpenAI $40 billion and is tied to efforts to build data centers in Texas and Ohio. Oracle, for its part, agreed to spend a reported $300 billion building new data centers for OpenAI in multiple states, and OpenAI would pay roughly the same to use them. Nvidia announced it intends to invest in OpenAI over the next several years, and then OpenAI would turn around and buy Nvidia's chips. That is the loop in a nutshell. The same horses betting on the same horses. Here's the risk. If OpenAI and the AI leaders don't deliver profits fast enough, that circular money machine seizes up. Barron's noted Oracle has given back its AI cloud momentum as investors grow cautious on OpenAI-linked revenue. Oracle has traded like a proxy for OpenAI, even though OpenAI isn't public and its valuation and profits are opaque. One reported OpenAI commitment to buy compute from Oracle on the order of hundreds of billions over time, juiced Oracle's forecasts. But then, market liquidity tightened, corporate debt sales popped, and private credit wobbled. If the AI payoff stretches out, stocks tied to that payoff could skid. Quick community question. Who do you think actually captures the value from AI? Chip makers like Nvidia? Cloud landlords like Microsoft and Oracle? Platforms like OpenAI and Meta? Or someone downstream using the tools? Drop a thoughtful comment with your take and why. I want to feature the smartest arguments in a future video. Beyond AI, watch the macro signals flashing yellow. CNBC reports hedge funds and other institutions have been big net sellers this year, unloading more than $67 billion in stocks and ETFs, while retail investors kept buying dips like they have since 2020. If pros are selling into a record-setting run while retail holds the bag, that's a classic tension. On the ground, affordability pressure is real. Foreclosure filings hit 36,666 in October, up 3% month over month and 19% year over year, suggesting some households are straining under higher costs. Meanwhile, major companies are cutting jobs. Verizon is planning roughly 15,000 cuts, showing big corporate headwinds. Put it together, and the picture looks fragile. A top-heavy market leaning on rate cut hopes and an AI narrative that may take longer to monetize than traders expect. That doesn't guarantee a crash, but it raises the odds of a pullback or stagnation if earnings don't show up on schedule. Policy choices matter too. Tariffs raise prices by restricting supply, which is why lowering import taxes on essentials like coffee and bananas in deals with Argentina, Guatemala, El Salvador, and Ecuador can help affordability. Free market moves like increasing supply and cutting burdensome regulations can ease pressure, especially in energy and housing. But for markets right now, the main story is AI concentration, circular cash, and whether the Magnificent Seven can keep carrying the load. If you love clear, fact-driven breakdowns of complex market stories, make sure to subscribe for more deep dives just like this. We'll keep tracking earnings, liquidity, and whether the AI flywheel is spinning or stalling. Is this creative destruction paving the way to real productivity, or an AI fueled bubble that's about to pop?